Welcome to video 5C on the timing of income. So, of course, now that we know what gross income is, we need to determine when to report that income. So, almost all individuals file tax returns on a calendar year period. Corporations are eligible for a fiscal year end, so they can choose whatever month end they want. Partnerships and S corporations are a little more limited. They have some flexibility, but not a ton. And we'll cover that later on in the course. But in either case, the taxpayer's method of accounting generally determines the calendar year or the tax year in which the realized income is recognized and included in gross income. So typical accounting methods, a corporation typically uses the accrual method of accounting. And we'll find that the accrual method doesn't agree exactly to what we've learned in our GAAP accounting system. And individuals use the cash method. However, starting in 2018, if gross receipts over a 3-year period on the average are less than 25 million, and that number is now increased up to 26 million in 2019, then the cash method is okay even for a corporation. So the Tax Cuts and Jobs Act really expanded the types of entities and the size of entities that were eligible to use the cash method of accounting. That number was much, much lower in 2017. Okay, so under the cash method, the timing of income recognition falls to a concept known as constructive receipt. So constructive receipt is purposely different, of course, than actual receipt. And the rule says the taxpayer must realize and recognize income when it is actually or constructively received. So the regulations help explain what it means to be constructively received. So income, although not actually reduced to a taxpayer's possession, is constructively received by him in the taxable year in which it is credited his account, set apart for him, or otherwise made available so that he may draw upon it any time, or so that he could have drawn upon it during the taxable year if notice of intention to withdraw had been given. However, income is not constructively received if the taxpayer's control of its receipt is subject to substantial limitations or restrictions. So the point here is that it's not required for actual receipt. Constructive receipt is good enough. So Maud is a cash method taxpayer, and she receives a check for services provided in the mail in the last day of December in year 1, so on December 31st. So is that income in year 1 if she waits to deposit the check into year 2? And I think the answer here is, well, no, that's income in year 1, right? Because, or I should say, yes, it is income in year 1 because she has control over that money in year 1, even on the last day of the year. What if she doesn't even open the envelope? Well, again, that's something she was in control of. When she decided not to open the envelope, she was in control. Therefore, that is still income. It was constructively received in year 1. What if she refuses to check the mail? Well, by now, hopefully you figured this out. She's in control of that choice. It is still constructively received in year 1. What if the mail comes after her bank is already closed for the day? Well, this is clearly a limitation, but it is not a significant limitation. So remember that income can come in any form, right? So if it was cash in that envelope, it doesn't matter whether the bank is already closed for the day. But this is a check. Well, a check is just a form of property. And would it be any different if it was chickens that came in a box? And the answer is no. She's in control. It's constructive receipt. Therefore, it is still income in year 1. What if the check was supposed to be for 1,000, but it was accidentally written for 100? Well, in this case, of course, only the 100 would be year 1 income. The remaining 900 that was received in year 2, subsequent to the mistake being discovered, that's all next year's income and therefore would be gross income in year 2. What if the check was post-dated? Now, this is an interesting question, and depending on when you would examine this question, you might get a different answer. But currently, the banking rules permit a bank to negotiate a check on behalf of a depositor without deference to the post date on the check. So if, for example, I took the check, I went to the ATM, or I just took a photo of it and deposited it, there's a pretty good chance the bank is going to process that check cashing. If, on the other hand, I walk up to the teller and I give the teller a post-dated check, they will often refuse that check. So, under the kind of strict interpretation of constructive receipt, even a post-dated check is still considered income in the year that it was received. If, on the other hand, the reason that check was post-dated is that the client explained to the taxpayer that it would bounce. Basically, there are insufficient funds. In that case, there is a substantial limitation. So what is a check? A check is just a piece of paper with some numbers written on it. And without the backing of the funds being in the account, it's just a worthless piece of paper. And so as a result, if the taxpayer is aware that the check is drawn on an account that has no funds, that meets the substantial limitation requirement. That would not be income in year one. Instead, it would have been constructively received when the funds are available into the account. Okay, so for whatever reason, the text that we're using this semester puts the timing of income recognition under the accrual method in Chapter 9. So we just covered the cash method. We'll cover the accrual method in Chapter 9 as a result. Okay, another item I want to talk about is the claim of right doctrine. And this covers when income is received even when there's a potential for repayment. So claim of right doctrine says when there are no restrictions on the use of that payment, then as a result, that is constructively received and would be considered income. And again, it all turns on this idea of control. So Seymour Skinner is a school principal. He embezzled the field trip money from students during the year. At that time, he had unfettered control of the funds. So even though it was embezzled money, he could have done whatever he wanted with it. He could have bought a new car. He could have taken a trip to Cuba. He could have given a ring to Edna Krabappel. Whatever the case is, he had control over them. As a result, even though technically he would need to repay them if he's caught, that's income to Skinner. Now, when the embezzlement is discovered, the tax benefit rule would permit him to deduct any reparations if he, for example, had to pay back all the money he stole.
Well, it's time to pick up where I left off, as a no-good street punk.
Principal Skinner?
Up yours, children.
All right. So in addition to determining when taxpayers realize and recognize income, it is also important to consider who recognizes the income. And this question arises a lot when an income shifting strategy is involved, referring back to our planning variables that we covered in the last module. So the assignment of income doctrine says that the taxpayer who earns the income from services must recognize the income. And it says that income from property, for example, dividends and interest, is taxable to the person who actually owns the income producing property. So what that means is to shift income from property to another person, you must also transfer the ownership of the property to that other person. So let's say, for example, you owned a bond and that bond paid interest. And you wanted to somehow shift that interest, that unearned income, to your kid. And so you said, oh, I'm just going to give the interest check to him and deposit it in his account. That's not enough to assign the income. Instead, you would have to actually give the bond to the child. That brings us to the end of video 5C. Thanks for watching.